do you trade with a 12-month forecast? Like, or how do you recommend investors manifest these views in portfolios?
Yeah, absolutely. So what we're trying to do is orient our portfolio construction in accordance with the next 3 to 6 months on a from a conditional probability perspective. So right now we mostly the next 3 months, because what we found, I mean, I've been doing this for over a dozen years now, and anecdotally, the asset markets tend to start to price in the new regime somewhere between 1 to 3 months, not further. Jim Leitner, who runs Falcon Head, I forget the Falcon something, but he was in Inside the House of Money. This is back in '08, a book in '08, and he was talking about the regime segmentation process and effectively how you don't get paid to be front run the regime. You typically want to be kind of within the first couple months of the regime. And so that's, understanding that, learning, understanding, just kind of watching this process play out anecdotally over the, long period of
Well, that's
time.
an interesting concept. So just so that I
Yeah.
understand it, it's you don't get paid for being too early,
Yeah,
right?
of course.
This is kind of like, how many people before '08 were like in 2005, I was hearing calls
Totally.
for the real estate housing market collapse. I mean, most of the people in the big short were big shorting years before they should have, and
Totally.
became
You get parted out.
ostracized, bit like lost their families, lost their
Well, I mean, thank
sanity.
God. I mean, my former boss got fired for shorting too big, and I wouldn't have had a job had he not gotten fired. So, knock on wood, that was a good thing. But
Druckenmiller shorting too early. Like, it's an interesting concept. So you're better off actually taking the first hit along with everybody else, because you're
yeah,
not going
so
to get fired if you're taking the first hit with everybody else. You just, from then, don't be paralyzed. Start making some moves. Yeah,
exactly.
I like
So
that.
just wait for the market to tell you, hey, we're starting to price it in. That's what this whole process is about. I know based on the econometric side of this is easy, or easy enough for someone who's been doing it for as long as that. The hard part is, this variable kind of dynamic with which the market starts to price it all in. The market can start pricing in like coincidentally, like Q4 of 18 when we transitioned to deflation then, and the market effectively was like on the day on the screws, or it could kind of start to price it in, ahead of time. This is like, you look at January of 2020, a couple months ahead of time before we actually observed and experienced the deflation. So the reality is you kind of want to live in this next 3 to 6 month view, but really the 3 month view. And so our portfolio construction, I'll give you guys a quick glance at it, because I don't want, we've got to keep our ETF exposures out of the public view, just for, respect of our paying subscribers. They're paying for that information. But the portfolio construction, the bets we're taking in the portfolio construction from a pie chart allocation perspective will represent the grid regimes, the size of the grid regimes in this probability table. And so
And
right
that
now, as you might imagine, inflation had been the largest one, but we actually just made some sales today, so we're a little bit more balanced with deflation down cash.
So I'm
So
not
you
clear as
do.
to what you recommend, like what instruments you recommend be used.
Yeah.
Are they
So
mainly
we
equities, just
no,
ETFs?
everything. Yeah. So we back tested everything through the lens of those grid regime processes, through the lens of the deltas, the impulses in growth and inflation, what policy rates doing, what the balance sheet's doing, what the fiscal policy is doing, what the rest of the world's doing, and we blend it all together through the lens of volatile or expected returns, percent positive ratios, volatility and covariance. So volatility and covariance are on the x-axis here, percent positive ratios and annualized expected returns on the y-axis. And what we're trying to do is help investors visualize according to our forecasts of what's happening over the next 3 to 6 months in the econometric side of things. Visualize the kind of exposures they should be long and short. So if you draw like a slope of one here, you obviously those would be the longs, these would be the shorts, high risk, low reward, low risk, high reward. And so we do this across every asset class: U.S. equities, global equities, commodities, fixed income, foreign exchange, and then we ultimately help investors kind of shrink that whole discussion into, okay, these are the types of exposures I should be picking from on the long side, to get into, to fit myself into one of those pies, right? And so that's
Right.
my
Okay.
that's how the whole process works. It's understanding the conditional probability over the next 3 to 6 months of realizing something in the economy, allowing the market to say, hey, it's actually starting to price that in, and then making sure the bets we're making in our portfolio construction correspond to the size of the pies or the size of the probabilities in that distribution.